What you're about to hear is going to sound impossible, outrageous even, but I need you to stay with me, because what's happening right now in the precious metals market is something most people won't see coming until it's too late. And by then, the opportunity to protect yourself will have vanished. Here's the situation. Gold has been climbing relentlessly, breaking through resistance levels that analysts said would hold for years. Silver has been following, but with a volatility that tells a very different story. And while the mainstream financial media is busy talking about stock market rallies and tech earnings, something far more significant is happening behind the scenes. Central banks around the world are accumulating gold at a pace we haven't seen in over half a century. Not slowing down, not pausing, accelerating. Why? That's the question nobody in the financial establishment wants to answer honestly. Because the real answer reveals a truth about our monetary system that most people aren't prepared to hear. The dollar's dominance, the thing that has underpinned global trade and American prosperity for decades, is being systematically dismantled, not by conspiracy theorists or doomsday preppers, but by the world's largest economies, working in coordination, moving deliberately, and doing it right under our noses. Let me paint you a picture of what's actually happening. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been expanding. They've added new members. They've been developing alternative payment systems that bypass the dollar entirely. They've been settling trade in their own currencies. And most importantly, they've been buying gold, massive quantities of gold. China alone has been adding to its reserves month after month, and those are just the official numbers they're willing to report. Industry insiders believe the actual accumulation is far higher. Russia, despite sanctions, despite being cut off from SWIFT, despite everything the West has thrown at them, has been stockpiling gold and using it to back trade agreements. India has been repatriating gold from foreign vaults, bringing it home. These aren't random moves. This is a coordinated strategy to create an alternative to the dollar-based system. And gold is the foundation of that strategy. Now, before we go further, I want to make sure you have access to something that could be crucial for your financial future. I've put together a free guide that breaks down the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth from what's coming. It's in the description below. No cost, no obligation, just information that could make a real difference. Grab it while you're thinking about it, then come right back, because what I'm about to show you next is even more critical. Here's where this gets really interesting. When you look at the mechanics of the gold market, you start to see something that doesn't add up. The paper gold market, the futures contracts traded on the COMEX, the unallocated gold accounts at the LBMA in London, these represent claims on far more gold than actually exists in physical form. It's a fractional reserve system, just like banking, but for precious metals. And it works fine, as long as nobody asks for delivery. But what happens when the music stops? What happens when major players start demanding physical metal instead of paper promises? We've already seen stress fractures. There have been moments when the spread between paper gold prices and physical gold prices diverged significantly. Times when you couldn't buy physical gold at the spot price because premiums spiked. Times when delivery delays stretched from days to weeks to months. Think about what that means. If you're a central bank, if you're a sovereign wealth fund, if you're managing billions or trillions of dollars, and you're watching the geopolitical landscape shift, watching currency wars intensify, watching inflation erode purchasing power, where do you turn? You turn to the one asset that has maintained value for thousands of years. The one asset that can't be printed, can't be inflated away, can't be devalued by a central bank's policy decision. You turn to gold. And here's the thing that should terrify anyone paying attention. The supply of gold is essentially fixed. Annual mine production adds roughly 1 to 2% to the total above-ground supply each year. That's it. Meanwhile, demand is exploding. Central banks are buying. Wealthy individuals are buying. Institutions are buying. And the retail investor, the average person trying to protect their retirement savings, is just starting to wake up to what's happening. Silver tells an even more dramatic story. Silver has industrial applications that gold doesn't. It's used in solar panels, in electronics, in medical equipment, in batteries for electric vehicles. The green energy transition that governments around the world are pushing requires massive amounts of silver. At the same time, silver mine production has been declining. Many silver mines are actually byproducts of other mining operations, copper or zinc or lead. When those operations slow down, silver production drops. So you have increasing industrial demand, declining production, and on top of that, you have investment demand surging as people recognize silver as both an industrial metal and a monetary metal. The gold to silver ratio, which historically averaged around 15:1, meaning 15 ounces of silver equaled 1 ounce of gold, has been wildly out of whack for years. It's been trading at ratios of 70, 80, even 90:1 at times. That's not normal. That's not sustainable. And when that ratio corrects, when silver catches up to where it should be relative to gold, the price movement is going to be explosive. Let me take you back to a moment in history that most people have forgotten, but that's incredibly relevant right now. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold, effectively ending the Bretton Woods system that had governed international monetary relations since World War II. At the time, gold was priced at $35 an ounce. That was the official rate. Within a decade, gold had soared past $800 an ounce. That's not a 20% gain. That's not a doubling. That's a more than 20-fold increase. Why did that happen? Because the world lost confidence in the dollar's stability, because inflation spiraled out of control, because people realized that a currency backed by nothing but government promises and military power was not a reliable store of value, and they rushed into gold. We're seeing echoes of that moment right now. The federal debt has exploded to levels that would have been unthinkable a generation ago. We're talking about trillions upon trillions of dollars in obligations that can never realistically be paid back in today's dollars. The only way out is inflation. Print more money, devalue the currency, make the debt easier to service in nominal terms, while destroying the purchasing power of everyone holding dollars. Central banks around the world see this. They understand the game. And they're protecting themselves the only way they know how, by accumulating hard assets, by diversifying away from dollar reserves, by preparing for a monetary system that looks very different from the one we have today. Now, there's another piece of this puzzle that doesn't get talked about enough, and that's the difference between the official narrative and what's actually happening on the ground. When you read mainstream financial news, you'll see articles about gold being a barbarous relic, about how it doesn't generate yield, about how it's just a shiny rock with no intrinsic value. You'll see analysts predicting that gold has topped out, that it's due for a correction, that investors should rotate into stocks or bonds or whatever asset class Wall Street is pushing that week. But when you look at what the smart money is actually doing, when you look at the actions rather than the words, you see something completely different. You see billionaires buying gold. You see family offices allocating significant portions of their portfolios to precious metals. You see central banks, the institutions that literally create money, choosing to hold gold instead of their own currencies. That should tell you something. There's a concept in markets called revealed preference. It means that what people actually do with their money reveals their true beliefs more accurately than what they say. And right now, the revealed preference of the world's most sophisticated investors and institutions is screaming one message: get into hard assets, get into gold, get into silver, and do it before the window closes. Let me tell you about something that happened not too long ago that perfectly illustrates the fragility of the paper gold system. There was a moment when a major investment bank had to scramble to find physical gold to meet delivery obligations on futures contracts. They had sold paper gold, collected premiums, assumed they'd never have to actually deliver the metal because most contracts get rolled over or settled in cash. But this time, the buyers wanted physical delivery, and the bank didn't have it. They had to go into the market, buy physical gold at a premium, arrange for transport, deal with logistics they hadn't planned for. It was a mess, and it revealed something crucial. The paper market is built on the assumption that physical delivery will remain the exception rather than the rule. But what happens when that assumption breaks down? What happens when more and more participants demand physical metal? You get a squeeze. You get a situation where the price of paper gold and the price of physical gold diverge dramatically. You get shortages. You get delivery delays. You get premiums that make it prohibitively expensive for average investors to acquire metal. And by the time the general public realizes what's happening, The opportunity to get in at reasonable prices has evaporated. This is why timing matters. This is why understanding what's happening right now, in this moment, is so critical. We're in a window where physical gold and silver are still available at prices that, while elevated from historical norms, are nowhere near where they're headed. We're in a window where you can still act, still protect yourself, still position your wealth for what's coming. Think about your retirement savings for a moment. If you're like most Americans, you've got money in a 401k or an IRA invested in stocks and bonds, managed by people who are following the same conventional wisdom that's been repeated for decades. Diversify across asset classes. Stay invested for the long term. Don't try to time the market. And under normal circumstances, that's not terrible advice. But these aren't normal circumstances. We're living through a period of monetary experimentation that has no historical precedent. We've got central banks around the world running negative real interest rates, meaning the interest you earn on savings is less than the rate of inflation, guaranteeing that your purchasing power declines over time. We've got governments spending money they don't have on a scale that defies comprehension. We've got geopolitical tensions rising, supply chains fragmenting, and a global monetary system that's showing cracks in its foundation. In that environment, the conventional wisdom might not be wisdom at all. It might be a recipe for watching your life savings get eroded by forces beyond your control. And that's where gold comes in. Not as a speculation, not as a get-rich-quick scheme, but as insurance, as a hedge against the very real possibility that the financial system we've relied on for our entire lives is going through a transformation that will leave a lot of people on the wrong side of history. Now, I want to address something directly, because I know some of you are thinking it. You're thinking, this sounds like fear-mongering. This sounds like someone trying to scare me into making a rash decision. And I get that. There's a lot of noise out there, a lot of people selling doom and gloom to push products. But I'm not asking you to take my word for it. I'm asking you to look at the evidence. Look at what central banks are doing. Look at what's happening with the BRICS nations. Look at the trajectory of government debt and monetary policy. Look at the historical precedents for what happens when fiat currencies lose credibility. The evidence is there. It's not hidden. It's not secret. It's just not being talked about in the places where most people get their financial information. And that's by design. Because if everyone understood what was happening, if everyone rushed to protect themselves at the same time, the system would collapse under its own weight. Here's something else to consider. Gold and silver aren't just about protecting against catastrophic scenarios. They're about preserving purchasing power in an environment where inflation is the default setting. Even if we don't see a complete monetary collapse, even if the system muddles through, the long-term trend is clear. Currencies are being debased, purchasing power is being eroded, and hard assets are the only reliable way to maintain wealth across generations. Think about what a dollar could buy 50 years ago versus what it can buy today. Think about what it will buy 50 years from now if current trends continue. Now think about gold. An ounce of gold 50 years ago could buy a quality men's suit. An ounce of gold today can still buy a quality men's suit. That's what we mean by preserving purchasing power. Gold doesn't make you rich. It keeps you from getting poor. And silver, with its dual nature as both a monetary metal and an industrial commodity, offers even more upside potential. When industrial demand surges, when investment demand kicks in, when the supply deficit becomes undeniable, silver has the potential to outperform gold by a significant margin. We've seen it happen before. In the late 70s, silver went from single digits to nearly $50 an ounce in a matter of months. That kind of move is possible again, especially given the structural supply issues we're facing. Let me shift gears for a moment and talk about something practical. If you're sitting on retirement savings, if you've got $100,000 or more in a 401k or IRA, there's something you should know about. It's called a gold IRA, and it's a way to get physical precious metals into your retirement account without triggering taxes or penalties. A lot of people don't realize this is even possible. They think their retirement money has to stay in stocks and bonds, that they're locked into whatever their employer's plan offers. But that's not true. You can roll over funds from an existing retirement account into a self-directed IRA that holds physical gold and silver. The metals are stored in a secure depository, they're allocated to your account, and they grow tax-deferred just like any other IRA investment. I've put together a guide that walks through exactly how this works, what the rules are, what the costs are, everything you need to know. It's in the description. And if you're serious about protecting your retirement from the kind of monetary chaos we've been talking about, it's worth looking into. I'm not saying you should put everything into gold. I'm not saying you should abandon diversification. But I am saying that having some portion of your wealth in physical precious metals, outside the banking system, outside the reach of monetary policy experiments, is a form of insurance that makes sense in the current environment, especially when you consider what's at stake. Now, let's talk about what happens next. Where do prices go from here? What are the catalysts that could drive the next major move? There are several factors converging that suggest we're on the verge of a significant acceleration. First, there's the technical picture. Gold has been consolidating at elevated levels, building a base, absorbing supply. Every time it dips, buyers step in. That's a sign of strong underlying demand. When you see that kind of price action, when you see a market that refuses to go down despite negative headlines or profit-taking, it's usually a precursor to a breakout. Second, there's the fundamental picture. The supply-demand dynamics we've talked about aren't getting better, they're getting worse. Mine production isn't keeping up with demand. Recycling can only provide so much supply. And the biggest buyers, the central banks, aren't price sensitive. They're buying for strategic reasons, not because they think gold is cheap or expensive. They're buying because they need to diversify their reserves, because they're preparing for a world where the dollar isn't the unquestioned global reserve currency. Third, there's the geopolitical picture. Tensions are rising across multiple fronts. Trade wars, military conflicts, sanctions, counter-sanctions, the fracturing of the global order into competing blocs. Every one of these developments increases uncertainty, increases the appeal of safe haven assets, increases the likelihood that investors will seek refuge in gold and silver. Fourth, there's the monetary policy picture. Central banks are trapped. They can't raise interest rates high enough to truly combat inflation without crashing the economy and triggering a debt crisis. They can't keep rates low without fueling more inflation and destroying currency credibility. They're stuck between a rock and a hard place, and the only way out is to keep printing money and hope they can manage the consequences. That's bullish for gold. When you put all of these factors together, when you look at the technical setup, the fundamental supply-demand imbalance, the geopolitical instability, and the monetary policy trap, you get a picture of a market that's coiled and ready to move. And when it moves, it's going to move fast, faster than most people can react. That's the nature of precious metals markets. They can be quiet for long periods, grinding higher slowly, boring the casual observer. And then something triggers a rush, and prices gap higher, and suddenly everyone wants in, and premiums spike, and availability becomes an issue. If you wait until that moment to act, you've already missed the opportunity. I want to tell you about something that happened during the financial crisis. In 2008, when Lehman Brothers collapsed and the global financial system teetered on the edge of complete meltdown, there was a brief moment when gold actually dipped. People were selling everything, raising cash, meeting margin calls. Gold got caught in the liquidation. And for a few weeks, you could buy gold at what turned out to be generational lows. But here's the thing. Most people weren't buying. They were panicking. They were watching their stock portfolios implode, watching their home values crater, watching their retirement savings evaporate. They weren't thinking about gold. They were thinking about survival. And by the time they regained their composure, by the time they started looking for safe havens, gold had already started its massive run higher. It went from the low 800s to over $1,900 an ounce in less than 3 years. The people who bought during the panic, the people who had the presence of mind to act when everyone else was frozen with fear, those people made fortunes. Not because they were smarter or luckier, but because they understood what was happening, and they had the courage to act on that understanding. We're not in a panic moment right now. We're in a different phase. We're in the phase where the smart money is quietly accumulating, where the warning signs are visible to anyone paying attention, but where the general public is still complacent. This is actually the better time to act, because you can do it calmly, deliberately, without the pressure of a crisis forcing your hand. Let me give you another historical parallel. In the 1930s, during the Great Depression, the government confiscated gold from American citizens. They made it illegal to own monetary gold. forced people to turn it in at a fixed price, and then immediately revalued gold higher, effectively transferring wealth from private citizens to the government. Could something like that happen again? It's not impossible. When governments get desperate, when they need to recapitalize their balance sheets, when they need to restore confidence in their currencies, they do desperate things. But here's what's different now. We live in a global economy. Capital is mobile. Information flows freely. It's much harder for any single government to impose the kind of draconian controls that were possible in the 1930s. And even if they tried, there are ways to protect yourself. Holding gold in allocated storage outside your home country. Holding silver, which has never been subject to the same confiscation risks. Diversifying across jurisdictions. The point is, the risks of not owning precious metals are greater than the risks of owning them. The risk of watching your purchasing power erode, of seeing your retirement savings lose value in real terms, of being caught on the wrong side of a monetary reset, those risks are real and present. The risk of government confiscation or some other extreme scenario, while not zero, is far less likely and far more manageable. Now let's talk about silver specifically for a moment, because I think silver is the most underappreciated opportunity in the precious metals space right now. Silver has been in a structural supply deficit for years. That means annual demand exceeds annual supply, and the gap is being filled by drawing down existing inventories. But those inventories aren't infinite. At some point, they run out, and when they do, the price has to rise to either incentivize more production or destroy demand. There's no other way to balance the market. The problem is, you can't just turn on silver production like a light switch. It takes years to bring new mines online. It requires massive capital investment. And with silver prices having been suppressed for so long, there hasn't been enough incentive to make those investments. So we're heading into a situation where demand is accelerating, supply is constrained, and inventories are dwindling. That's a recipe for a price spike. And unlike gold, which is primarily a monetary metal, silver has this huge industrial component. The solar industry alone is projected to consume massive amounts of silver over the next decade. Electric vehicles, 5G infrastructure, medical applications, the list goes on. This isn't speculative demand. This is real physical demand from industries that need silver to function. And they're going to pay whatever price is necessary to secure supply. When you combine that industrial demand with investment demand, with the potential for silver to catch up to gold in terms of the gold to silver ratio, you get a scenario where silver could dramatically outperform gold on a percentage basis. We're talking about the potential for triple-digit percentage gains, possibly more if the stars align. But here's the catch. Silver is a much smaller market than gold. The total value of all the silver in the world is a fraction of the total value of all the gold. That means it doesn't take as much capital flowing into silver to move the price. But it also means that when the price starts moving, it can move violently. Silver is more volatile than gold. It can rise faster, but it can also fall faster. You need to understand that going in. For most people, a balanced approach makes sense. Some gold for stability and wealth preservation, some silver for upside potential and industrial exposure. The exact allocation depends on your risk tolerance, your time horizon, your overall financial situation. But the key is to have exposure, to have some portion of your wealth in physical precious metals outside the financial system, immune to the kind of monetary manipulation that's become standard operating procedure for central banks around the world. Let me address one more objection I hear frequently. People say, but gold doesn't pay dividends. It doesn't generate income. Why would I hold an asset that just sits there? And that's a fair question. In a normal environment, in a world where currencies are stable and inflation is low, and the financial system is sound, you might prefer income-generating assets, stocks that pay dividends, bonds that pay interest, real estate that generates rent. But we're not in that world. We're in a world where the yield on bonds doesn't keep up with inflation, meaning you're losing purchasing power even as you collect interest. We're in a world where stock valuations are at historic extremes, propped up by central bank intervention and share buybacks funded by cheap debt. We're in a world where real estate prices have been inflated by decades of easy money and are vulnerable to a correction if interest rates rise or the economy stumbles. In that environment, the fact that gold doesn't generate income is actually a feature, not a bug, because it means gold isn't dependent on the health of the financial system to maintain its value. It doesn't need a functioning stock market, or a solvent banking system, or a stable government. It just is. It's a store of value that exists independent of all the fragile structures we've built on top of it. And when those structures start to crack, when the illusion of stability gives way to the reality of systemic risk, that's when gold shines. That's when people remember why civilizations have valued gold for thousands of years. Not because it's pretty, not because it's rare, but because it's the ultimate form of money, the one asset that can't be debased, can't be printed, can't be manipulated by politicians or central bankers. We're running out of time. Not in some abstract theoretical sense, but in a very real practical sense. The window to acquire physical precious metals at reasonable prices is closing. Every month that goes by, more people wake up to what's happening. More capital flows into the sector. More supply gets locked up by long-term holders who aren't selling, and the price adjusts accordingly. If you've been on the fence, if you've been thinking about this but haven't acted, now is the time. Not next month, not next year, now. Because the forces we've been discussing, the central bank buying, the BRICS de-dollarization, the supply deficits, the monetary policy trap, these aren't going away. They're accelerating. And the longer you wait, the more expensive your insurance policy becomes.